So now let's take a look at how to apply the 5 steps to particular questions. And you need to download the webinar tasks, work through them, and then review this if you get stuck or you need some guidance. I'm going to take you through these step by step. On the 1st of January 20x6, with the Martha's Flowers task, what we've got is a contract. So we are dealing with that first step. Is there a contract in place? Is there consideration? Yes, $15,000. Is there a transfer of goods? Yes, roses are going to be handed over. So we're going to provide 1,000 roses every month for 5 months, 5,000 roses. The total contract price, $15,000, so $3 per rose. These roses could be sold separately, $4.50 each. Now, things change on the 1st of March when Sam's wife passes away. She loved roses. She gets an additional 600 have been ordered for her funeral. So what we've got here is a change in the scope of the contract from 5,000 roses to 5,600. But these roses are being provided free of charge. So they are not going to change the price. Therefore, we have to consider that in step 1 and how we deal with this variation. So the key question here is, what happens for our revenue recognition for the month of March? So step 1, yes, there's a contract in place and it meets those criteria, but now we have a change or a variation. Has the scope changed? Yes, there are 600 more roses. Has the price changed? No, it hasn't increased. So therefore, although the rule says if there's a change in both scope and price, there is a separate contract, we have a situation where there is not a separate contract. So we tick that first criteria. Then we ask ourselves, is it distinct or not distinct, or a combination of both items? So there's 2 short videos. If you're unsure what this means, please watch them and work your way through. But in this situation, what we've got, we can either have a distinct change, and if that happens, we have to replace the existing contract and deal with the future revenue prospectively. I'll explain what that means in a moment. If it's not distinct, if it's not easy to distinguish between the change and what came before, it becomes part of the existing contract and you deal with it retrospectively. And if it's a combination of both, then it's a combination of both. So let's take a moment to look at prospectively. This means adjust into the future. So if you replace an existing contract, and in this case, January, February have already happened, it's the 1st of March, we don't touch January and February, but we do have to adjust March onwards because we adjust into the future. Now, if it was not distinct, then we would have to go back in time, retrospective, go back, and we would have to adjust the January and February amounts recognized. So in this case, we have a distinct change. We've got 600 more flowers being delivered in the next month. That changes it into the future. The past has already been dealt with. So we need to adjust the future revenue, and we do not make any changes to January or February. So how do we adjust the future revenue? What is it going to look like? That's the key question. So prior to the modification, each rose cost $3 or was priced at $3, calculated as we showed earlier. But then we ask, well, how much revenue has been recognized? In January, 1,000 roses at $3 each, $3,000. February, 1,000 roses, $3 each. So January and February combined is 2,000 roses, is $6,000. That would have been recognized. Now, because we are not doing a retrospective adjustment, this stays in place. So how do we recognize the remaining $9,000? Well, going into the future, we now have a new contract effectively where we have 3,000 roses plus 600, 3,600 roses, but the price hasn't changed. So if we see our price here at 9,000, that works out to $2.50 per rose rather than the $3 per rose that was achieved previously. So the way we're going to account for this in the month of March, which was the purpose of the question, is by saying there are 1,600 roses in March, and they are going to be priced at $2.50 each because that's how we apportion the amount. So we don't work it out as a total of 5,600 roses across $15,000. We do it on the remaining 3,600 roses on $9,000. So you can see it would be easy to fall into the wrong calculation if you don't know the rules of the standard. So what does it look like as a summary? So January unchanged, $1,000 at $3. February the same. March changes because we have 600 more being provided at $2.50. And you'll see that April and May retains this new price. Remember, we adjusted this prospectively into the future, but not retrospectively, not into the past. So the total 15,000 is still recognized across 5,600 roses. And this is the prospective change. So 4,000, then 2,500, then 2,500. Now, interesting outcomes here. For example, the same work was done in January and April, and yet April is now $500 less than January. So it throws up some interesting anomalies, but this is how we account for it. So let's now move on to the next task, which is Office Furniture Limited. And your job here is to identify the performance obligation. So you can see this is step 2 in the process. And as we work through these tasks, you'll become more and more familiar with how to apply the standard. So Office Furniture Limited, there's a custom-made desk. There's a contract price of $1,300, but this includes, so once again, we have bundling. We get delivery and installation and a desk. So Office Furniture Limited is not in the business of providing installation services separately. So that's giving you a clue that that can't be unbundled. If you go into a restaurant, and I often use the example of the burger and the fries and the drink, if you can buy them all separately, they can be unbundled. But if you can only get one thing combined with another, then it's not. So the standalone market price for installation is $150. The standalone delivery price would be $250. But bear in mind, installation services are not provided separately by this organization. So the standalone price of a desk is $1,300. We can see some pretty nice. So if you go to one shop, it's $1,300 for the desk, whereas these people are throwing in all of the other factors together. And that helps us later on determine how to allocate the transaction price to the purchase order. But how many performance obligations are there? In this case, there's going to be 2 performance obligations. One, the delivery of the desk. That's something that can be done, and that is separate. And the desk and installation. So remember the case fact said that the installation cannot be done separately. You cannot purchase these services separately. It's part of getting the desk. So that is combined together. We have 2 performance obligations. And that leads us to say, well then, what is the allocation of the transaction price? So do we know what the transaction price is? We've been told it's $1,300. So there's nothing too complicated there. And that's this step number 3. So we found out there's 2 performance obligations. We have a transaction price of $1,300. How do we allocate it across the components? And if you didn't know the standard, you might think, well, this is pretty confusing because the desk itself is worth $1,300. So maybe the delivery installation is free. It's zero. That's not going to work. So let's look through the case facts. Contract price, $1,300. And then we have some extra information. Installation, $150. Delivery, $250. So the total value in this situation is going to be $1,700 if we add all of those items together. Now we work out the percentage portion of the component. So if we've got delivery and it's $250 of a total value of $1,700, it's nearly 15%. So then we allocate this percentage to the total transaction price, and that gives us our portion. So $1,300 is our transaction price. 14.7% is linked because we've done our percentage weighting of what the $250 is of $1,700, gives us $191. And the remainder would be allocated to the desk. So now we have to look at another example, this time with shoes, to determine the transaction price. This is just to give you more practice and more experience. So one thing to note, don't include GST. I think that's pretty obvious. So if, for example, a desk was sold for $1,300 and it has GST on top, do not include the GST in the revenue portion. And the other thing that can make things tricky is variable consideration. So amounts might change. And was there any customer rebate? So things like an incentive or a coupon or a rebate or a cashback. Was there any bartering in the transaction? Sometimes people might pay cash, but other times they might pay for it with goods or services. And is there a financing component? So often you might buy a new motor vehicle, but if you've borrowed, if it's part of that transaction, there's a zero interest financing that you only pay off over 3 years, then there's going to be a financing component. You've actually borrowed money to finance that, and we need to be able to separate that out. That gives us clearer, more accurate information. So here's Entity W, sells 50 pairs of shoes, and it sells them for $70 a pair. So you could, basic revenue would be 50 pairs times 70 gives you your total revenue. But we know that there's going to be some customer returns, so we can't recognize the full amount. Now, we might get 2 pairs returned. That happens quite a lot. 60% of the time in the past, 2 pairs out of 50 or 1% would be returned. There's a 1/3 chance nearly of that no pairs would be returned, and that's fantastic. So 30% of the time that happens, and then 10% chance something's gone horribly wrong and 5 pairs get returned. So we can work out the expected value that we're going to receive in this case based on probabilities. So what we have is 30% probability that 50 shoes will be sold at $70. So we take the 50 times 70 and we adjust that for the 30% probability. Now, if you've ever done a weighted average calculation, that's what we're doing here. 10% chance that there'll be 5 returns and a 60% chance that there'll be 2 returns. And we now have a weighted average, which they call the expected value method. So it's as simple as putting the probabilities into a table and working out the calculation. That's our expected value method. So what if we use the most likely method? This is where it's relatively easy, but it's also easy to make a simple mistake. So in this case, the most likely outcome is the one that's 60%, because that's more than 30%, more than 10%. The most likely thing to happen is that 2 pairs will be returned. So then what we need to do is assume that we will have 2 pairs returned. So we'll sell 48 of the 50 at $70. And we've literally deducted 2 pairs worth of sales. We've deducted $140 to get our revenue amount. Now, one mistake people make is to take this number and multiply it by 60%. That's not correct. We don't want to do a weighted average. That was the answer to the previous question. So it is not $2,016. We only want to know about this 60% because that tells us the most likely item to occur. So now we're looking at transaction price in a situation where there's a non-financial consideration taking place. Mr. Smith sells antiques. There's a contract. Once again, that's that step 1 dealt with quite quickly and easily. And in this case, there's a painting. So that's pretty easy. There's only a single performance obligation. The painting is consideration. $800,000 in cash will be paid, but this is where it gets tricky. $100,000 worth of luxury car. But is it $100,000 or is it $80,000 or is it $150,000? So you can see that when you get given a question, you're going to get case facts, and some of them are going to be irrelevant. You need to know which is relevant and which is not. And then we also have this standalone selling price of the painting. So we're finding that the painting itself is worth $1 million, $800,000 cash. Do we add $80,000 or $150,000 or $100,000 to determine the transaction price? Because in this case, we are dealing with some non-financial consideration. So non-cash consideration taking place here. The other items aren't as relevant. There's no sort of consideration payable by the customer. There's no discount. It's not variable, and there's not a significant financing component. So let's see how we calculate it. Firstly, the cash component, nice and easy, $800,000. This is where it's tricky. Do we use the cost, the carrying amount, or the fair value? Well, here's the rules for figuring out the transaction price. What is customary business practice? Variable consideration, financing. Then we have this non-cash consideration that we want to look at, and then consideration payable to the customer. This is all in a spreadsheet for you to download as a PDF, as a flowchart. So please download it, have a look, and this will help you solve the question. But what are the rules? Well, we measure at fair value non-cash items to be received. That's the first thing we do. So we want to start looking for fair value of the non-cash items. It didn't say find the cost price, and it didn't say find the carrying amount. It said find the fair value. Now we have that at 150,000. It says, if not possible, measure at selling price of the goods and services promised. So this 1 million is only relevant if we didn't have the fair value of 150,000, because that's the selling price of the goods and services promised. So what do we need to do in this calculation? We can measure at fair value, the 150,000. So take our cash, take our 150, and we get a transaction price of 950. So if you chose 900,000, that would be wrong because you've used the cost price. If you chose 980,000, that would be wrong. And if you chose 1 million, that would be wrong because we did have a fair value. So you can't use that item. Can you see how using a flowchart to step through a standard is a great way of ticking off key facts from a question to avoid making mistakes? So we've worked through those questions, and that's the steps 1 to 5. There's a lot of short videos. Please look at them in more detail and practice until you're confident. Now, a couple of minor items to consider. Contract costs. When we enter into a major contract after a negotiation, then sometimes we can recognize those as assets. So if we have incremental costs, if we incur additional costs of obtaining a contract with a customer and the cost to fulfill a contract, we may be able to capitalize those rather than expense them. So when are we allowed to do that? Once again, here we have a flowchart approach. So just read the case facts, apply the flowchart, and then you'll get the answer correct. So are they incremental costs? And the case facts will always tell you if these costs could have been avoided. So, for example, if there's a commission cost and it is guaranteed to be paid if you win the contract, but it wouldn't have been paid if the contract was not won, then we can determine if it's going to be accepted or not. So can it be recovered? If it can, then that's what we do. And if not, we can expense it if the amortization period is less than 12 months. What if it is a cost to fulfill the contract? Then we can recognize it as an asset, but only if we satisfy each of them. Does it relate directly to the contract? Do the cost generator enhance resources to satisfy the purchase of performance obligation? And are costs expected to be recovered? So any question you get has to address these case facts so that you can determine how you will treat the item. And I would suggest go through question 3.4, have this flowchart, and sometimes this causes people, they get a bit stuck. How do I deal with, legal fees or commission costs or contracting? What goes where? This page should help you solve that. One of the original problems about the previous revenue standard was it didn't give enough information, disclosure about what was going on in the organisation. So one of the new reporting requirements beyond the calculation of what is revenue is how to report. And a key here is disaggregation. Because if you put all your revenues lumped together, it's hard to tell which parts of the business are doing well and which are not. So a requirement is to describe the nature, the amount, the timing, the uncertainty of revenues in different areas. So you might talk about different product lines. And you can remember back to module 2, and it talks about segment reporting. It's the same kind of concept. You can't just report on your whole business as one. You should break it up by goods and services. Or what most companies do is do it by geographical region. From there, the type of customer or the type of contract and contract duration. So you can see that the notes to the accounts will help someone perform much more detailed analysis. Then when you have a contract, you need to disclose the disaggregated revenue, any contract balances, how many performance obligations, and the transaction price. So we're giving more information to the users, and that prevents hiding of revenues or smoothing them around or bundling them. Gives a much clearer picture.